a range, what does that mean? That basically means a drift sideways to down in an overall constructed pattern, and ideally volume is becoming very low at the same time. Whatever makes sense for you and can keep your losses to a minimum, that's what you should use.
You will find a way. Like our minds are creative enough and smart enough to work with this pattern. If this is the only pattern that existed, people would figure it out because that's how our brains are wired. We will figure it out. The more you try to corner yourself to one buy, one sell, it gets a bit harder because you're shortening your execution time frame where you have to be present and look at certain factors for you to be effective in the market.
I've got a few slides on range breakouts, which is the entry tactic that I probably use the most. And then there's a few different variations that I'll get into. But remember, this is always in the context of an overall pattern. And in this diagram, this larger base is kind of the overall pattern. And then there's two potential entry tactics that I've highlighted where there's smaller ranges with smaller pivots. And that's kind of what we're focused on today. So getting into range breakouts, I define it kind of as a breakout from a short-term range and consolidation. A lot of people ask me, how long should that range be? Ideally for a daily range, 1 to 2 days, 3 days, 2-3 days is plenty. Subtle tightness is a really great tell and can produce some great moves. Again, in the context of a larger pattern, we're not just buying 2 days of tightness up 10% from the pivot, right? We're buying it as the overall setup is completing itself and becoming more mature. But I know a lot of, swing traders and day traders who might define a range as an inside day or, a few hours of tightness. It all depends on your time frame and your style in the market. So this is kind of a universal setup that occurs across multiple time frames. So yeah, a range. What does that mean? That basically means a drift sideways to down in an overall constructed pattern, and ideally volume is becoming very low at the same time. And that tells you that the supply and demand dynamics are constructive and there's subtle accumulation at work, and there's kind of a lack of sellers at that point. And what does this allow you to do? It allows you to get an early entry before that base pivot, where often the stock feels extended going into that, and then it bursts up 6% and you can't manage risk. But if you get in a little bit earlier up the right side of that base, you've already got a profit cushion going into that breakout, so you can handle any kind of short-term reactions to the downside. So there's a lot of benefits here. And if you miss that breakout, you can look for another consolidation, another range that you can position in, maybe not as much as if you caught it up the right-hand side, but you can still participate in that move. Again, another benefit of this is it allows you to manage risk tightly, often, less than 4%, 3%. If you do trade these range breakouts using either the low of the breakout day or the low of the range as your logical stop, whatever makes sense to you to say that this range breakout has failed, that's where you should place your stop. And we'll go through some examples as well. And Ryan, I'll request remote control just so it's a little bit easier for this section. But that's pretty much it for setting the overall context of this pattern. So moving on, where do you place your stops? I just kind of mentioned this. For me, you can place your stops below the higher low. I'll often use the low of the breakout day from the range as my stop because I'm trying to keep risk as tight as possible. But I'm always thinking, this tight area hasn't really failed, even if that one day fails, unless that higher low is violated, if that makes sense. So you can also use a percentage below, this pivot here. I don't like using raw percentages just because, I trade based on the actual price structure, and some stocks are going to be wider, some are going to be tighter. So for me, it's more about the market structure and where does that say the setup has failed. And again, keep your stops tight and logical. Whatever makes sense for you and can keep your losses to a minimum, that's what you should use. So in this example, again, we've got the overall pattern. We've got a range that forms at the right-hand side. We've got the entry at this consolidation pivot or range pivot, whatever you want to call it. And you can place your stop loss right under this higher low, because if you think about it, if the stock reverses and breaks this low, it just means the base at that point needs more time. And then it might tighten up again. And then that could be another constructive pattern. That could just be a future setup that you could exploit even if this initial setup fails. Then, moving through, if it breaks out, then sets up another tight area. We kind of pretty much saw this with the CLH chart. Think of this as the earnings gap. Then we got the consolidation, and then we look for a range, a tightness where we can buy through that pivot. And again, set your stop loss at the higher low or at the relevant, even tighter stop loss if you would like to. And I see the question, what time frame are you entering on? Personally, I'm trading mostly daily pivots. But I will go down to a 65-minute time frame for my entries, or even a 15-minute, but I don't go much lower than that. So again, it depends on your style. If you're more a swing trader, you're going to want to use primarily the daily and maybe a one intraday setup. But again, especially if you're new to this, stick to the higher time frames, master the overall concepts, and then you can always improve and get a little bit tighter as you go. And I also saw a question, when do I enter my trades? I enter when the stock's moving through the pivot. It could be 9:33. It could be later in the day. I ideally want a profit cushion going into the end of the day. So that's something to consider entering later in the day. But you don't want to just be waiting for arbitrary numbers, arbitrary times, like an hour, 2 hours after the bell. I won't enter until that happens. There's different strings of thought on this. Some people say, the first 30 minutes is amateur hour, and that could be 100% true for their system. Ryan, I know you say you enter most of your trades, right after the bell or soon after the bell. It depends what works for you in your process and your time frame, right? Swing traders, day traders, they're gonna do most of their trading in the first hour and last hour of the day. More position traders, investors might want to wait to see that confirmation because they're managing risk in a different way. They can open up their stops a little bit because their position sizes are a little bit lower. And then, there's all those different ways of thinking. But
this is where your creativity and how you can come up with a different way comes into play, right? We could say that, hey, volume support works for me, whole numbers work for me, range breakouts work for me. We're trying to show you guys ways that you can take these, but if make them find your own way, right? The edge that we get, Richard keeps saying that the overall pattern is more important for you to even deploy any of these entries and stop losses. So if you don't understand that part and you just go to a random stock and in the context of what you define an uptrend is not valid and you try to do that, you'll see failure, right? So take this and find maybe 50 examples of range breakouts that give you confidence. And then you're the subject matter expert at that point. You're the person that I could go to. Like Richard can eye these instantaneously as he's flipping charts. You need to eye these instantaneously for yourself for you to see success in them. What we're trying to say here and what we're trying to drive home is if you keep your entry tight and logical through that, and especially when volume comes into play as well, right? There's low volume as it pulls back, and then it goes through the pivot on bigger volume. If you visualize that instantaneously, your decisions will be so good, and you'll be the master of range breakouts, right? Getting to the point of trading the first hour, trading the middle of the day, the lunch hour, I've heard it all. It doesn't matter. So if you're a day trader, right, you try to avoid lunch hours because liquidity goes away and the thought process is that traders go for lunch or whatever the case might be. I've seen people avoid the word shakeout in the first 30 minutes. And my whole trading is based on the first hour. So I trade the first hour. I know I can anticipate the direction of the market quite well, right? 4 out of 10 times is really good. And if I do that every single day and every single week, I'm pretty well off. So that again that works for me. some people say it's amateur hour. My whole trading is based on amateur hour. Like it works for me. So I don't care what people call it. So it all take it back to what fits and what works and how you creative you could be, right? Um, People call HVs pegs or EPs or n number of different names, but at the end of the day, it's just a big volume stick on the chart, and they trade around it. So it doesn't really matter. Take it back, and if you find 40 examples, 50 examples, these you could trade it better than the person that's just watching this and not following up with it after the fact. They will not be able to eye the entry, but you can eye the entry because you trained your eyes for it. So
Yeah, and addressing some other common questions that I see a few in the chat. Personally, I'm watching the price action first. Then if volume is coming at the same time, that's awesome. I use the volume run rate data point in Deep View to assess, in real time, how is volume tracking versus the average. And it's great if that's 100%, 200%, 500% above average, but the price action move is really what I care about. Ideally, I want to see volume coming in later, but that's a secondary thing. And then also, I see a few people trading full time is tough to buy these entry points and to use these entry tactics. I would say it's definitely tougher, but make use of alerts. Raya, I know you trade from your phone. You almost prefer that.
well, my execution is based on my phone.
Yeah,
So I
Oliver
can have
Kell
my
won,
charts up
and Oliver
and
Kell won the U.S. Investing
yeah.
Championship trading from his phone. So use your alerts. In DeFi, you've got hundreds of alerts at your disposal. Use those. Take a quick glance at your chart if you can, and also you could use buy stops, sell stops. I did that when I was working at the Naval Research Lab. I couldn't watch charts during the day, and I still found success with that. So whatever style or constraints you have, you can find a way to make it work. And in some way, those constraints can become an edge where you're not super worried about the as Stan would say, the wiggles and jiggles on the chart. Like that would scare you out. So plan ahead and
There are different
yeah,
ways too. Like
yeah,
Ross maintains end of day stops, right? So his whole his end whatever he enters, then he will see it through the end of the day, and he won't make a decision in the middle of the day. Doesn't obviously if there's some news, etc. There's always exceptions to what we're saying, but that's what works for him. So um, there's so many different ways. I think we can shift our focus a little bit to what we feel. If you take this bigger pattern exists, you see a higher low and you see range contraction, you could define a consolidation pivot over and over and over again. Even if you're working full time, people can place buy stops sometimes, right? People do place. So if you're concerned with price, you can place buy stops, and then your execution is a day over day, and you will find a way. Like our minds are creative enough and smart enough to work with this pattern. If this is the only pattern that existed, people would figure it out because that's how our brains are wired. We will figure it out. It's a matter of making sure you just do it again and again, and then you'll find some creativity in your thought process to allow you to make it work at the end of the day. So
yep. So moving on to the next one. Again, here's thinking about the overall context of where these range breakouts can occur. They can occur up the right-hand side of the base over here. They can happen after that base breakout, which is basically what we saw with CELH, or it can basically be a pullback into that overall area of interest. And we'll also talk about buying versus a level today and entry tactics for that. So thinking about where this pattern can occur, these are kind of three main archetypes that you can think about. All right. So trading at range, there's kind of four different variations of this, which I'll get into. I primarily use more the third and fourth, which are in the next few slides. But these first two, you can accumulate versus the lows of that range. Rye, this is more kind of what you do versus a level, right? So you've got that whole number level. You buy as it's coming into that level. It's supported at that level. Your stop is right below that level. And especially for people managing larger accounts like Rye.
this work, yeah.
Yeah.
I see a lot of people, hey, I will make one buy and it works. one buys work, I would make one buy and place one stop. But when you scale your account, it doesn't really work. It's super scary and you can't manage your risk with one buy. So I recently, a good example of this was Uber, where it just came back in on low relative volume post earnings. The primary pattern was still intact. So this line on, uptrend, consolidate, right? So they came back in, consolidated, and it formed out a proper area. If it was, if it's going to break that range and close below it, I would sell my entire, position and just go out, continuously held, and then it came out of that range on the top side. But I accumulated over a span of like a week and a half where I didn't see anything wrong with the structure of this pattern. Price volume was below average, price was moving in, S&P and the Qs were breaking the 50 days. This thing's holding this range. So I had relative strength. It already had the highest volume edge from the primary pattern. Then I combined those two things from an edge perspective. Entry tactic was buy the consolidation lows and accumulate your position bit by bit, but know your exit. So knew my exit, never triggered, and now you're up on the position. Now you could scale up, move up your stop loss, right? The stop loss can be a little bit above the lows of the consolidation. Now you're in the money. Your mindset switches, from that to, can I switch to a 21-day rising? Can I switch to a 50-day rising as to how I will exit that position? But whatever it is, but barring a huge gap down and all of a sudden Uber makes no money overnight, which likely won't be the case, I will be in the money on this trade. And my psychology is positive, my mindset's positive. It's going to net me a positive return, a positive outcome. And that's all that really matters at the end of the day. People that work full time, and I think that's something we need to maybe make a bit of a focus on in webinars going forward. That your execution can be based on, the more you try to corner yourself, the one buy, one sell, it gets a bit harder because you're shortening your execution time frame where you have to be present and look at certain factors for you to be effective in the market, right? That's something I ran into as well, like myself. But if you had, I'm going to piece myself into this, and that's something Nick is big on as well, where he will accumulate a position, a third, or a third, could be a fourth, or a fifth, 20%. Ross does this as well. He will accumulate position, but he will have on the top side a consolidation, but I'm going to finish it off when it moves through this consolidation on the top side, right? And that's where he routes. So maybe he has 20%, 20%. We're at 60. All of a sudden, this doesn't come back and breaks the top side. He rounds that position off, buys the additional shares on the top side if he feels that this thing's not going to come back anymore. So then his average price is somewhere in the middle here. His stop loss is still very defined, and he can then manage the trade accordingly. So,
yeah. Perfect. So the second kind of variation is buying tightness, anticipating the breakout through the top side pivot. And you can place your stop, below, an even tighter, higher low entry, end of the day. You've got your stop here. But the key thing is here, if your anticipation doesn't pay off, you got to make sure you honor your stop, because if it just trickles back to the low of the range, you're now watching this level. Oh, if that breaks, I'll watch the 50-day moving average. You guys stick to your original plan, stick to the entry tactic that you were using, and execute. Yeah, Ryan, you want to add something there?
Yeah, I mean, the creativity of how to enter includes some solid line in the sand on what my stop is, right? Don't get creative with stops. Basically, if you get creative with stops, then this will keep coming in and you'll just say, it's holding the 21-day. Now it's holding the 50-day. Now it's holding the 65-day. Now it's holding the 200-day. And now your entry was here and the stock is all the way over here. And don't be creative with your stops. Follow whatever it is that, you came up with as a stop, and make it non-negotiable, basically. for
Yeah,
yourself.
your stop has to make sense for the entry tactic you're using and stick with that no matter what price action does. So yeah, these are the first two variations. I don't, Rye, I know you use this one quite a bit. I don't use this one too much, but I know there's very successful traders who do that, and they're valid ways of trading these ranges.